Welcome to the Deep Dive, your shortcut to being well-informed. Today we are laser-focused on Beam Global, that's ticker BEEM. We're digging into their Q3 2025 operating results, which dropped after the market closed on November 14th.
And it is crucial context for you to know, Beam has had an extremely volatile year. I mean, it's underperformed the broader clean energy market by a huge margin. So our mission today really is to dissect this quarter. It's defined by a steep financial drop set against a backdrop of management trying to pull off a pretty radical strategic pivot.
Okay, let's get right into it then. We're talking about a company known for its off-grid EV charging systems, but these headlines, I mean, they paint a picture of some genuine distress. Give us the raw snapshot. How bad were those Q3 financials?
They were a clear and pretty painful miss across the board. Revenue came in at $5.8 million. That is an almost 50% drop year over year. Almost exactly. You compare that to $11.5 million in Q3 of 24, and it missed Wall Street's consensus by about 35%.
Wow. A 50% revenue decline is, I mean, that's devastating. What did that do to their bottom line? I mean, even more concerning, their whole profitability structure.
Well, the GAAP earnings per share was a loss of 28 cents. That missed the consensus target, which was a loss of 25 cents. And this is just a dramatic, really unpleasant swing from last year, where they actually reported a positive GAAP EPS of 9 cents. But the most alarming figure, I think, was the GAAP gross margin. It turned negative for the quarter, landed at negative 1%.
So on paper, Beam Global just reported something close to a disaster. But here's the really critical market nuance here. Despite those terrible headlines, the stock barely moved the next day. It was largely muted, closed the session pretty much flat. So what does that tell us? What was the market actually looking at?
It suggests the street had already priced it all in. You know, they were expecting significant volatility, maybe even anticipating some bad news. The muted reaction basically forced investors to just ignore the headline numbers and focus completely on management's story. On their forward-looking narrative and their explanation for all this volatility, they were selling the past and buying the future.
Exactly. So let's dive right into that story. Management had a very specific reason for why that revenue number just fell off a cliff. They pointed directly at a concentration risk failure, specifically the U.S. federal government's fleet electrification push just not materializing.
Precisely. The CEO said the decline was primarily due to unfavorable order timing. He claimed a single $3 million federal order from a longtime customer, no less, slipped entirely out of Q3, and now it's expected much later, probably the first half of 2026.
Wait, hang on. If they only reported $5.8 million in revenue, a single $3 million order slipping means that one client, that one agency, represented over 50% of their projected sales. So, I mean, while management is blaming order timing, doesn't that massive concentration risk itself just scream a fundamental failure of planning, of diversification?
That is a highly valid challenge, and it shows the danger of relying on these huge monolithic government contracts. They're just notoriously prone to delays and, sudden political pivots. The CEO used this example to argue that if that one order had converted, revenue would have been closer to 10 million. And those GAAP gross margins, they would have been around 20%. So in their view, it's not a lack of business, it's a logistics problem they're now aggressively pivoting away from.
And that concentration risk brings us right to margins and efficiency. That negative 1% GAAP margin is a bright red flag. But the non-GAAP picture offers a critical difference we need to spell out for you.
Yes, this distinction is absolutely critical. GAAP, or generally accepted accounting principles, it requires them to include these heavy non-cash costs, like depreciation and amortization. These relate to big past investments in factories and equipment. But when you exclude those non-cash charges, their non-GAAP gross margin was actually 13% for the quarter.
Okay, so in simple terms, that 13% non-GAAP number tells us that their operational efficiency is positive. Their ability to actually build the product, source the parts, and deliver it. That part is profitable. Even if the accounting rules drag the headline number into the red because of old sunk costs.
That is the takeaway, yes. And what's even more encouraging is the trend. Year-to-date 2025 non-GAAP gross margin is 22%. That's a 4 percentage point improvement over 2024. That 4-point improvement suggests, real underlying gains in their supply chain, procurement, and just absorbing their fixed costs better when they have volume. They're building the product more cost-effectively than they were a year ago.
And that efficiency gain is a huge operational win buried under that terrible revenue number. And this discipline, it showed up in their expense control too, right?
It did, yeah. Despite the revenue miss, the non-GAAP net loss actually slightly improved year over year. It went down to $2.8 million from $3 million. And this was driven by some aggressive cost cutting, about $1.5 million in total decreases across salaries, marketing, and getting their European operations streamlined. They are definitely focused on controlling the cash burn.
They also made sure to stress their balance sheet, which is, essential context when a company is in this kind of transition.
Right. They are debt-free. They hold $3.3 million in cash and have $10.9 million in working capital. They also repeated that they have access to a $100 million undrawn credit facility. However, we can't ignore the capital markets overhang.
Let's pull on that thread. They concurrently filed a 424B5 prospectus supplement. For our listeners, what exactly does a 424B5 filing signal when it drops alongside earnings like these? What does it mean for dilution risk?
So a 424B5 filing is essentially a shelf registration. It lets the company sell debt or equity securities in the future. It's a signal to the market that, while they have cash and credit today, management thinks they will need to raise external capital, probably in the short to medium term to fund their big international expansion plans. And that creates persistent execution risk and, importantly, dilution fears for shareholders until that capital is actually raised.
Which makes the next part of the story, this strategic pivot, even more high stakes. The reason they need that future capital is to fund the shift away from their now, defunct core business.
This is the massive theme they just hammered home on the call. They have dramatically reduced reliance on the U.S. federal government. I mean, look at the numbers. Commercial customers now account for 82% of Q3 revenue. That's up from 48% last year. And international customers, they were 39% of year-to-date revenue, almost double the 20% share from the year before.
So they weren't just pivoting. They were reacting to the ground, completely dissolving beneath them. The CEO said it frankly. He said the U.S. federal business has, quote, completely evaporated 100%, which forced this radical diversification.
Yeah, that frankness just underscores the urgency. And if we connect this to future growth, the most anticipated new engine is the Middle East. Management detailed the new joint venture, Beam Middle East LLC.
Tell us about that, JV. What makes the structure so much better for Beam compared to their old federal contracts?
It's a 50-50 partnership with the Platinum Group in Abu Dhabi. They're specifically targeting a region that's planning roughly $1 trillion in sustainable infrastructure investment. And the favorable structure detail is absolutely critical here. Beam gets reimbursed for any costs they incur in the pre-profit stage. That happens before any profit sharing with Platinum Group even begins.
Okay, that cost reimbursement is huge. It significantly lowers the upfront financial risk for Beam. But let me challenge that for a second. Are they just swapping one highly concentrated volatile customer, the U.S. Feds, for another, Middle East government and infrastructure projects? Isn't there still a massive execution risk tied to government deals in a new, high-growth, but also potentially volatile region?
That is the core debate, yes. While the financial structure is better, the execution risk is still high. The trade-off is velocity. Management is arguing that deployment and project approval in the UAE is just dramatically faster than the U.S. federal bureaucracy. So they're essentially trading that sluggish timing risk for a geographic execution risk.
And the CEO was actually on the call from Abu Dhabi, right? Emphasizing that this wasn't just some paper JV. He was highlighting their products, the EV ARC, the wireless charging at the DriftX trade show, positioning them for autonomous vehicles and drone charging.
Correct. The CEO noted that the show was full of autonomous vehicles, but almost none of them had an autonomous charging solution. Their systems, which remove the need for a human to plug something in, they solve a key bottleneck for large-scale autonomy. This moves them way beyond simple EV charging into, critical infrastructure enablement.
And beyond just geography, they're deepening their product portfolio. They're explicitly trying to shift from one-off sales to platforms that generate recurring revenue. They mentioned BeamBike and BeamFlight.
Yeah, BeamFlight, which used to be called UAV ARC, is a patented drone recharging system. It was originally made for military use in contested environments. But the tech's rapid shift into commercial use, logistics inspection, is designed to stabilize revenues and build those annuity streams. It's meant to replace the lumpiness of that old federal business.
And what about the battery and energy storage system side, the ESS business? They aren't treating that like a commodity either.
Absolutely not. They are targeting highly differentiated, high-margin custom applications. That example they gave about the submersible drone manufacturer is key. This client needed a battery with double the energy density and lifespan to fit into this incredibly tiny space on the drone. That shows they're selling a very specific engineering solution that competitors just can't easily replicate. And that's what protects those high ESS margins. And that segment's clearly working. ESS revenues are up 21% this year.
They even highlighted a humanitarian tech application with the BeamWell product.
Yes. The BeamWell product is deployed right now with the Royal Jordanian Armed Forces for use in field hospitals. It provides not just electricity, but crucially reliable drinking water from salt or brackish water. And their stated intention to deploy these units in Gaza for humanitarian relief, that shows a really powerful off-grid application with enormous value.
So if we look at the pipeline that's supposed to support this whole repositioning, what kind of visibility do they actually have?
The contracted backlog, so we're talking firm purchase orders, that stands at $8 million. Management was very clear that significant pipeline opportunities, including that slipped $3 million federal order and some recent European city tenders they've won. None of that is included in the $8 million. They only count firm POs.
Okay, that provides some near-term visibility. And the renewal of that GSA MAS schedule through 2030, plus a new Sourcewell contract, that should, in theory at least, make public sector sales easier moving forward.
It creates a simpler pathway, yeah, but the fundamental capital challenge is still there. Like we said, the stock is down over 56% in the last year. It's just severely underperforming the sector. The investment community is still heavily weighing the near-term revenue volatility and that capital market overhang from the debt prospectus.
Which raises an important question about cost and execution.
Yeah.
Why the aggressive push for vertical integration? Why are they acquiring power electronics expertise now?
The CEO gave a very clear reason for that, rooted in reliability and margin. He explained that 99% of all their EV ARC product failures or warranty issues came from third-party components that they were buying. So vertical integration aims to slash warranty costs, drastically improve reliability, and most critically, recapture margin by cutting out that third-party middleman, all the packaging and air, as he called it, that they were paying for. It's an investment to make the product better and cheaper over time.
Okay, so let's tie this all together. What does this mean for you, the investor? We had two profoundly different stories here. On one hand, a steep revenue loss driven by a dead-end legacy business, and on the other, a really cost-disciplined pivot into a high-margin, option-rich international platform.
Right. Management's narrative is that they are 1,000 times better company today than when the stock was trading far, far higher a year ago. But your skepticism is necessary here. They're asking you to take a huge leap of faith based purely on future execution. The core question is this: is the market valuing Beam on its old, failing federal segment or on its potential in the Middle East, custom ESS, and drone infrastructure?
It's time now for the outrageous trade segment. This is a highly speculative look at a binary outcome bet. This is not financial advice. But if we were pitching a leveraged strategy based purely on the optionality we've just discussed, what's the thesis?
The thesis is simple. The market has assigned zero value to the strategic optionality they've built, especially that Middle East JV. The long-term value is tied entirely to these new platforms where their costs are reimbursed and the margins are high. We are betting on a major strategic success headline.
And how would you structure that high-risk, high-reward bet?
We'd structure it as a speculative binary bet. You'd buy far out-of-the-money call options expiring in, say, mid-2026. This isn't about incremental quarter-over-quarter growth, not at all. This is a leveraged bet that the Platinum Group's influence in the Middle East converts one of those high-profile autonomous vehicle or drone contracts into a firm, large purchase order announcement within the next 6 to 9 months.
And that single large PO announcement would be the pure catalyst. It would cause a short-term multiple expansion spike long before the actual revenue even hits the books.
Exactly. It's a bet on the velocity of deployment in that UAE environment. You're betting that the scale of this huge pivot gets validated by a major tangible order that confirms the success of the whole JV model.
And that wraps up our deep dive into Beam Global's Q3 2025 results. We've seen a company struggling with steep revenue losses, but at the same time aggressively trying to pivot into high-margin commercial, international, and recurring revenue streams, all spearheaded by that cost-protected Middle East joint venture.
The ultimate test for management will be proving they can generate enough volume and scale in those new channels faster than the cash burn dictates. Can they successfully offset the risk that comes with those necessary future capital raises?
That tension scale versus burn is the crucial final thought you need to consider as you digest this report. As always, this has been an analysis of the provided information and is absolutely not financial advice. Thank you for joining us for this deep dive.